The US economy is showing clear signs of deepening trouble. So much that it might even flip the Fed to start cutting rates at the end of this month. Now, policymakers have pledged to be patient, but that was only so long as they could plausibly pretend everything was strong and resilient. As I keep saying, it all comes down to jobs, and the information we're getting on jobs continues to go way down. Not only that, summertime is usually the time for recession. Just today, we got a critical reading on U.S. services, which just plunged, worse since May of 2020. More important, this isn't some outlier. Weakness has been building and building, and its employment measure sunk into clear recession depths. Straight up unemployment signals are more visibly turning too. A sharp and sustained spike in jobless claims put them at their highest since November of 2021, with no sign of that stopping either. Add these to the constant warnings from big companies who've been telling us they have to cut prices, their customers have no money. It is a small leap from these warnings to those companies cutting their own costs, meaning jobs. The recession signals are getting louder and louder, and eventually they get to the point even Jay Powell won't be able to dismiss them as no big deal any longer. Besides, he really only says the economy is strong and resilient in public. As the data gets uglier and uglier, even traders are becoming more aggressive in hedging for lower interest rates. Not just lower bond yields that we already have, lower front-end money rates like SOFR that tend to be tied to Federal Reserve policies. As Bloomberg reported just last week, traders in the U.S. rates option market are embracing a nascent wager on the Federal Reserve's interest rate path. A whopping 3 percentage points worth of cuts in the next 9 months. Over the past 3 sessions, positioning in the options market linked to the Secured Overnight Financing Rate, or SOFR, shows an increase in bets that stand to benefit if the central bank reduces its key rate to as low as 2.25% by the first quarter of next year. Such an outcome, which appears unlikely unless the U.S. economy tumbles into a sudden recession, yeah, that's the point, would mean at least 300 basis points of easing from the current levels. That's it. That's exactly what traders are doing. They're beginning to hedge more aggressively for all the recession signals that we get throughout the U.S. economy. Again, Powell says strong and resilient in public, but yet the data continues to come in not strong and not resilient, as we'll go over in just a moment. So it makes sense that traders in the marketplace would, if they're concerned of all this data and what it actually represents, they would begin to hedge for recession scenarios. And hedging against SOFR going down, would be a very clear way of doing so. So as the article states, yes, unless the economy tumbles into recession, this seems like a poor bet. But it only seems like a poor bet because Jay Powell continues to say strong and resilient over and over again. And if the only thing you ever hear is Jay Powell's mouth, you might not see all the rest of the data, which continues to get uglier and uglier. Not just uglier and uglier, more decisively in that direction. Appearing at the ECB's conference just yesterday, their version of Jackson Hole in Portugal, Powell admitted that what keeps them up at night is a possible nonlinear turn in the labor market, because they keep saying strong and resilient, but the truth of the matter is, in most recessions, in fact, the vast majority, what happens is everything looks strong and resilient up until the point it suddenly doesn't. Now, of course, that's not really what happens. We tend to ignore all the warning signs that don't fit with the narrative that's been put out there by officials. But in most cases, what you see is that the economy starts to slow down. It looks somewhat concerning, but otherwise appears to be fine, but then suddenly rolls over and everything's not fine. And if you don't incorporate and really understand and appreciate the warnings that are coming from all of these different places, from companies, from the data, then you could miss that transition point. It does seem as if the recession shows up out of nowhere, but that's not really the case. And as Powell was saying yesterday, he started out with the strong and resilient. Yes, the labor market is incredibly strong and resilient. Therefore, we don't need to cut rates that right away. But then he was asked that question. Because the U.S. economy is strong and the labor market is strong, they keep using those terms, we have the ability to take our time and get this right, talking about rate cuts. And that's what we're planning to do, what they're planning to do, what they're forecasting to do. But when Powell was asked what keeps him up at night, He pointed to the delicate balance between taming inflation, which is already done, and avoiding a significant deterioration in the labor market. Quote, "It's very much understood by us that we have two-sided risks, and we have to manage them." That's what he said on a Powell with ECB's President Christine Lagarde and the head of Brazil's central bank as well. What he means by two-sided risks is they still claim that inflation could be a big problem. It could suddenly ignite and become resurgent again. That's the Fed's one fear, the one side of it. But the other is this nagging recognition. It's as if all of a sudden they pull the rug out from under, especially the labor market. Again, as I said, that's not actually true, because there are a number of warning signs that happen before you get to that point of nonlinearity. But those warning signs are often just dismissed, ignored, downplayed, or whatever, especially when the people we all are led to believe understand the economy the best, these policymakers and economists at central banks, continue to tell us that everything is fine. So like I said, Jay Powell in public says the labor market is strong and resilient, but he even admits that he's worried that it might not be, because he sees all of these warning signs and the deteriorating data as well. And so he knows, while he won't say it in public, he knows there's a non-trivial chance that this all turns out the wrong way, and it can happen very quickly. Now, to cut through the spin in all this mainstream misdirection, that's why Eurodollar University offers memberships and subscriptions. And they are now on sale at some of the lowest prices we've offered since our launch. I just did a conversation with Eric Besmajian of EPB Macro Research on the recession question. There's tons of videos on everything from basics to the history of money, and especially ledger money. A webinar replay. We just did a webinar last week on the fundamentals of interest rates. That's available for members and subscribers too. We have the deep dive analysis where we dive deep into interest rates and go far beyond all of the topics I bring up here on YouTube. And of course, a daily briefing to keep you up to date on everything that's happening in money and macro. And we have anniversary sale prices on everything. So check out our website, eurodollar.university, for all the details. You got to get behind the mainstream spin to the actual truth. Again, the Federal Reserve and policymakers have pledged to be patient. Now, one reason why they could change their mind quickly, obviously the deterioration in the U.S. economy, especially the labor market, the signals we're getting there. But beyond that, and we'll get to that data in just a moment, before that, other central banks around the world have already started to cut, and they've done so despite breaking their pledges on what they call inflation. Prominently, the ECB, the woman sitting next to Powell on the stage at Sintra in Portugal, Christine Lagarde, they already cut rates even though consumer prices haven't done what they claimed they were supposed to be doing. They said we were going to fight inflation until the moment, we were not rest until the moment when consumer price measures got back down to their target. Well, consumer prices in Europe have not come back to the target, and they're starting to look stickier, as sticky in Europe as they are elsewhere around the world, and yet the ECB cut rates anyway. So there's a precedent there, and they're not the only ones. I talked about the Bank of Canada just recently. Bank of Canada, and the Canadian economy in general, is in a very similar shape to the United States. Again, more recession type of behavior, consumer prices that are roughly equivalent, they're looking sticky, and yet the Bank of Canada earlier last month cut rates as well. And they did so kind of mentioning their growing unemployment problem too. And so the Bank of Canada cut rates on rising unemployment even though job growth is nominally positive, which again points to a way in which the Federal Reserve could justify rate cuts as well. So Powell could take the Canadian and European examples and adapt them to the US and say, yeah, we're okay with where consumer prices are. We're now more confident about that. It doesn't matter if he actually believes it. We're looking at the two-sided risk, and now they're tilting more decisively in the labor market. And so just like in 2019, we're going to start cutting rates because we want to have a little bit of insurance that we do hit the soft landing. And that's another thing, too. Powell knows that the chances of an actual soft landing in any economy are slim to begin with. It doesn't happen in history. So the two sides of the Fed's risk, one is consumer prices, and those continue to calm down. They're not calming down at the rate nor in the manner that most people would like, because that's the nature of the supply shock. We kind of have to ride with it. But now we get to the downside of the cycle, the real downside of the cycle, or the final stage of that downside of the cycle, because this has been a cycle all along, and it continues to play out that way, even if it's on a protracted, prolonged schedule. But the downside of that cycle was always going to be focused on jobs, 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 the other side of the Fed's two-sided risks. And we continue to get, especially recently, more indication that something changed, something has substantially changed in the jobs market. Now, it has been weak before we get to the last couple months. As I've been saying, we've been in a half recession to 3/4 of recession already, largely because companies stopped hiring last fall. Now, they may have been laying off some workers, but it hasn't been a substantial, massive wave of layoffs that we normally associate with recessions. But we've been halfway there with the hiring freeze, some minor job cuts, as well as the conversion of full-time jobs to part-time jobs, cutting hours among the workforce. Companies have been taking steps that we all associate with recession, just not that final step. And so we're waiting for the signal that maybe that's beginning to happen in more widespread fashion. And some of the more recent data is looking and tilting in that direction. Initial jobless claims, those continue to be relatively tame and low historically, but they have clearly moved up from the last couple of months. Now, we've been waiting for initial jobless claims to pass the middle of June because they did the same thing last year. And there is a possibility that the increase in jobless claims this year was nothing more than an unaccounted for seasonal quirk. The statistical factors that in the post-pandemic environment, the Department of Labor is having difficulty really parsing out of the data. So if initial claims continue to at least be elevated, if not rise, after the middle of June, which seems to be that seasonal peak, then that would suggest something has happened and it's not just this seasonal quirk in the data. And that's what we got this week. The latest number for initial claims is 238,000, up from 234,000. So it's stabilizing at a higher rate than it had been in the previous months, suggesting that something is indeed in the process of changing as far as unemployment. On the other side, though, continued claims. That one has been up sharply. It was up sharply for the fourth straight week as of the latest weekly data. 67,000 increase in those 4 weeks. And so just looking at the chart, you can see how something has definitely changed. It brought the level of continued claims up to 1.86 million, which is the highest since November of 2021. And they've been rising for 9 straight weeks too. So there's a pretty clear signal that something seems to have changed in the labor market. In terms of continued claims, that would mean more people who are being let go can't find a replacement job. Again, going along with the idea that companies are cutting back. They're certainly not hiring in the way we want them to, and the hiring in a way that would be consistent with a strong and resilient economy. So if continued claims continue to move up, that's a very strong recession signal. It's a pretty strong one already, but the more it goes, the more consistent it is, the stronger that signal becomes, and in employment. But I think the most shocking data from today was the ISM's services PMI. The ISM services PMI plunged to 48.8. That's down from 53.8 in the month of May. The 48.8 is for the June number. And 53.8, the month of May, was sort of an outlier. And you could see it all along the way. Because the ISM services, along with a lot of other data, have been weakening, and we've been talking about this ever since September and October. And here you can see it in ISM services. So the weakness is not a one-off or an aberration. It was the bounce in the May number that was actually clearly an outlier. And there's an issue about seasonality in those statistics too. Because of that, though, because it had been 53.8, everyone was expecting that the ISM services would only come down a little bit from that 53.8. Analysts were thinking 52.5, but instead 48.8, which doesn't sound all that bad, but when you put it in the historical context, 48.8 is clearly a recession number. You go back to the 2010s. The weakest ISM services in the 2010s was the polar vortex of February 2014, and that was 51.6. You don't have anything even close to that in the entirety of the 2010s. And the 2010s were not a good decade for the economy, services or otherwise. And then you compare the 48.8 and again the trend toward 48.8 that we just got for June. I mean, that's equivalent to September 2008, which was 49.4. And it's basically even with the depths of the dot-com recession. And all the internals were weak too. New orders 47.3, which is the lowest since that winter storm late in December 2022. Prices, they moved down a little bit. But in the context of what we're talking about here, employment. The employment index tumbled all the way to 46.1. Now, that's just only 0.2 of a point better than the April number. We got 45.9. And it's not far off of December's 43.8. That was a shocking low. So you got 3 really bad employment indexes in the last 7 months. And again, it's a very clear trend in the ISM Services Employment Index to now what are consistent with the depths of recession. 46.1 is right there with the dot-com recession, and it's at least halfway or a little bit further into what we got during the Great Not Recession in 2008 and 2009. And of course, the mainstream is absolutely shell-shocked by these results. Quote, we're hoping that this is a blip, according to Steve Miller, who's the chair of ISM Services Business Survey Committee, as he said in an interview on Bloomberg Radio. It doesn't seem like a shock from the overall commentary, but it certainly wasn't good news. And they're just in complete denial because Jay Powell says strong and resilient, strong and resilient, strong and resilient, and they believe him. He has to say strong and resilient. He's lying to you about strong and resilient because he thinks he has to say that. And everybody just parrots that same line, even as the data that they're presenting shows that the economy and employment and jobs are not strong and resilient. And the more it shows not strong and resilient, the more we get closer to that point of nonlinearity. And that point of nonlinearity will be a surprise to people who follow Jay Powell. But as I keep saying, if you ignore and downplay all of these warnings that keep coming up, these serious warnings, the more serious warnings, and the more widespread warnings, then it will be a surprise. But it actually isn't, because we're in a cycle, the downturn of the supply shock, and it continues to act like we're in a cycle, and it gets closer and closer to that final stage of that downturn to the cycle. So as the recession signals get louder and louder, the Federal Reserve won't be able to ignore them. The one caveat here is, of course, Friday's payroll report. If the payroll number happens to stumble sharply, then you have to believe that a July rate cut is in play. Because as I mentioned, summertime is the time for a recession. And with the jobs number possibly being weak and everything else that corresponds with it, the Fed is going to want to get ahead of that growing weakness that we can see around the rest of the world, the unemployment wave that has already been unleashed in other parts of the global economy. And it's already there if you look for it. And if you actually don't downplay it and dismiss it or ignore it, you can see it in the U.S. The unemployment rate has already risen. And it's already risen to a level that is consistent with where the Fed thinks it will stop. And so all of this data that we continue to get suggests very strongly that the unemployment rate is not going to stop. And so if we get a bad payroll number, the Federal Reserve is going to look at that and all the rest of this data and say, yes, maybe we need to start thinking about cutting rates too. In fact, not just start thinking about it, we might need to act. We'll just use the ECB and Canada template and say, okay, we're declaring victory on inflation. Now we're more concerned about adding some insurance in case the U.S. economy gets weaker than it already appears to be. Because on top of everything, the Federal Reserve has known all along that the soft landing, the chances for a soft landing were slim to begin with. And with summertime being the time for recession and all the data looking increasingly ugly, July is their last chance to get ahead of everything. I had a very detailed and fascinating discussion with Eric Basmajian of EPB Macro Research. Part of that you can see at the video link below. The rest of it is available to Eurodollar University members and subscribers. Check out our anniversary sale to become one of those. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers, the existing ones, and until next time, take care.